in the market. A rights issue, basically, for those of you who may be hearing, what does it mean by rights? It means that a company listed on the stock exchange is asking the existing shareholders to bring in more money by issuing additional shares or giving bonus. So that's what a rights issue means. But let man who is going to unpack a bit of this for us, from the rights issue to the capital importation, and look at the hot money versus cold money, is Omotola Abimbola, one of the investment analysts at Afrinvest Securities. Thank you very much. Let's have that handshake, but that's not going to be as long as the one with the governor.
Morning, Boason.
Good morning. Let's start with the rights offering market.
Okay.
This year has been a major boom. As we speak, we have one company, one cement company doing a multi-billion naira offering there. What's your take on this spate of offerings from, except the banks? Almost every other person, every other company or segment.
We've had one bank, actually, Union Bank, come out earlier in the year for a right.
Oh, yeah, that's true. Yeah. Yes, that's Union. Yes. Union was the only one. But the industrials and the consumers seem to be the one taking the headlines. So USC, Flour Mills, Lafarge, and the rest, they seem to be pushing the banks aside. The banks look very comfortable anyway.
You're right. Definitely. We have seen a flurry of capital, we have seen a flurry of rights issue offerings in the market since the beginning of the year, thanks to improved capital market sentiment due to flexible foreign exchange policy implemented by the Central Bank of Nigeria as of April 2017, which culminated in the opening of the high and high window. And also because of the higher oil prices and improved appetite for Nigerian assets. So we have seen companies come out to the market to raise more equity capital, essentially to sort of deleverage their balance sheets, which became impaired during the economic challenges that we faced between 2014 and 2016. So for a number of these companies coming out to raise equity capital, for instance, Guinness, Unilever, Union Bank, and even Lafarge Africa, the intent of the money is to optimize their capital structure, reduce the amount of debt that they have, and increase equity. The only company looking to raise capital to finance an expansion plan is probably UACN, who are using the money to expand some of their products offerings across the cereal markets, as well as real estate as well. So speaking to the purpose, for raising capital, it's been two. One, to optimize balance sheets, particularly for the industrial goods and the consumer goods companies, and second, to finance expansion, talking about UACN's rights issue.
If banks or financial services company like insurance and commercial banks do a rights issue, perhaps folks think, well, what they just want is more money because they are already a quasi-money institution. Yes. But for industrials and consumer goods, what does that speak to in terms of what the purpose for the rights offering is all about?
I think it still shows that the economic recovery we are witnessing is still shaky at best. It is not yet on full steam because we are not seeing companies raise capital to finance expansion. Guinness, came out earlier in the year to raise some capital in order to, because in 2016, when we had severe FX liquidity, they had to obtain some intercompany loans from their parents' company. Same thing with Unilever. So right now, when we have improved capital market sentiment, they feel it is the right time for them to come to the market to raise some equity capital in order to pay off, those intercompany loans, and perhaps give the parents' company the opportunity to also swap the debt that they give to the company into equity investments. Into investments, So we're seeing the same thing for Lafarge Africa. Lafarge Africa, when they completed the acquisition of Unisem. Unisem is a cement manufacturing company in Cross River State. They produce about, they have a capacity of about 5 million metric tons of cement per year. But while they were undergoing their capacity expansion, they had to take some intercompany loans from the parents' company. And after the acquisition of the company by Lafarge Africa, so that obligation fell to Lafarge Africa's balance sheet, and they had to turn it in from a debt instrument, partly into an equity part into an equity instrument. However, with improved sentiment in the capital markets right now, they felt this is the right time for them to come into the market, to raise more equity capital, to pay off some of those intercompany obligations, as well as, reduce the finance charges that are on their books.
If you look at the macroeconomy, and of course, folks say, well, the stock market is not a true reflection of the economy. But again, these are big companies. They employ thousands and thousands of people. So we cannot discount that.
Definitely.
Again, you look at the consumer market. These are companies with very strong brand portfolios in the market.
Correct. But if you look at what's been happening in the consumer goods space over the past 1 year, of course, we have seen revenue for the companies. We have seen an improvement in it as of 9 months 2017, both revenue and profitability. However, that improvement in bottom line and top line is being driven by increase in products prices. So earlier in the year, many of them adjusted upward the prices of their products. So we are still not seeing a growth in volume. Because consumers are a bit challenged due to the high level of inflation and the slow economic growth. So I think the fact that we are seeing companies come to the market to raise capital, not to finance expansion, right, but to optimize their capital structure, shows that we still need deeper reforms in the economy so as to lead to real growth in volume of sales, that will necessitate higher capex investments by these companies.
Again, the flip side of it is that for companies with the headquarters, technically speaking, in Europe, perhaps in the US and other parts of the world, when you do a rights issue and you have your foreign majority shareholder say, look, we're going to give you dollars in cash to do what you need. If you do a rights offering, we're going to pick up this offering and convert it into equity. What does that speak to?
It also speaks to the fact that for many of these companies, the parent company actually still find the valuation very attractive. They consider that the valuation of their companies in Nigeria is at best, not up to the level that it should be. And if there is an opportunity for them to convert, their debt obligations into equity investments at the right price, they will take it because the long-term potential is still there. Nigeria is a frontier market, growing population at about 3% every year. With also very high GDP growth potential. So the long-term opportunities, are in the economy, but in the short term, we are still facing all these cyclical headwinds related to, the oil cycle, as well as, lack of structural reforms that's going to buoy economic growth in the country. So for them, they are playing the long game. That these companies, they're going to be here for a very long time. Let's support them as best as we could. And in the long term, we're going to, recoup our investment in these companies. We're
talking about companies that we can grab their financials off the shelf or just go online and pick them up. There are a number of companies that are, PLCs, not listed on any exchange, whether the NSE or the NESD, OTC, or even putting any bond on the FMDQ, but they're out there as limited liability companies in the consumers and industrial goods who are not captured by what we have right here on the table. Correct. So if you put that, if you look at that uncaptured production part of the conversation, where you have private equity, venture capital guys coming and putting dollars that just get a portion of the news reports, but because they're not listed on any exchange. Do you think we're making some progress along that line, even though we don't have the data right here at our fingertips?
Yeah, I think so. I think we have seen, some landmark transactions in the capital markets, in the economy, over the past couple of years, both in the consumer goods space and also in the technology scene as well. Although I would say that the interest has been more towards the internet startup space than even the typical, consumer goods or industrial goods segment in the economy, due to the level of innovation that we are seeing in Nigeria's startup space. So for companies, such as, Hotels NG, like To Let NG, and a number of them, they've been receiving lots of, equity funding, from foreign venture capitals, who are looking to play the long game in Nigeria's growth markets. But for the typical, consumer goods and industrial goods markets, I still think that for us to fully uncover the growth potential in these two segments, we still need deeper reforms in the economy. Per capita income is still so low, and we are not seeing, lots of spending by consumers. If you look at last year's GDP by expenditure data, you will see that consumer spending is actually declining in the economy. And for an economy where consumer spending is about 60% of total GDP, this is very, very important. If you also look at the last GDP reports for Q3, although we saw a positive growth of about 1.4%, the non-oil sector, which perhaps reflects what is happening in the economy more, actually contracted by about 0.8%. So we are seeing a recovery, but I would say that recovery is very slow and very sluggish, and there is a potential that it will be a long recovery if we don't see deeper reforms in the economy.
Yes, the state of the economy. What do you want to see to lift that side of this conversation? Foreign direct investment.
To lift foreign direct investment in the economy,
yes.
It has to be more reforms, both on the soft infrastructure side and the hard infrastructure. Soft infrastructure relates to ease of doing business metrics, such as construction permits, ease of entry and exits, out of the country, ability of companies to access finance. So these are very soft issues that could easily be solved if you have lots of political will going into implementing the ease of doing business reform. And thankfully, we have seen a positive performance regarding this in the past 3 or 4 quarters. Last year, the Presidential Ease of Doing Business Council was established, and they have done some work, related to trying to improve some of the soft infrastructure that we need to support investment in the economy. But be that as it may, we still need a lot of hard infrastructure in the economy. Investments in roads, investments in rail, investments in housing as well. So all these, and power sector. So all these things are very important to make our businesses very competitive in the global markets.
Okay. Let's, while we work on that, we'll put that as a work in progress. Let's come back after the break and talk about what's been described as hot money, which is portfolio investment, whether it's really hot or cold. We'll be back into everyone. I'm going to put this question directly to you. I'm going to read it off. Is hot money powering Broad Street?
It is. That's a fact, at least from the data. Data says so. But more importantly, looking at the capital importation data that came out yesterday, I think we can still pick some positives out of it, and there are some negatives as well. The positives first, we were able to get about $4.1 billion of capital inflows in Q3, which was the highest since Q3 2014, when we had the oil boom, when it started, faltering. And that rebound in capital importation was driven by 2 major sectors or categories. That's foreign portfolio investments, what you termed, short money, hot money. That's the money going into buying financial security with a short-term perspective. And we also had a boom in loan investments or loan inflows. We had some foreign capital raisings by both the corporates as well as the federal government, during the quarter, particularly the diaspora bond, which closed around that time. So that led to improvements in loans inflow. But speaking to the foreign portfolio investment, it was essentially driven by higher inflows recorded in the equity markets, I think about $1.9 billion compared to the fixed income market. So some positives, we are getting the flows, although we are not getting the right type of flows that we want as an economy to grow. FDI, which is the foreign direct investment, the money that goes into creating jobs in your economy, it is at its lowest level in more than 3 years. Perhaps 4 years, at more than $70 million.
We're going to leave the cold money. Let's stick with the hot money, because we need to go in there. When we nosedived in 2014, and I've gotten a few comments. Your colleagues, colleagues, because you folks are analysts as well, from United Capital, and this is what they wrote this morning about capital importation into Nigeria. Hot money up, cold money down. That's what they said. This is what I was trying to quote. It says, portfolio investors are fair weather friends who would not hesitate to exit at the slightest sign of a trouble.
Yeah, that's the reality. Hot money, as the name implies, it blows hot and cold. So when the capital market sentiment is positive in your economy and you have all your key macro anchors, oil prices positive, exchange rates, liquidity positive, these flows come in. But when the tide turns, they go out. So it is not money that you can use to grow your economy. You need more of FDI inflows, to create jobs, and grow the economy. I
agree with you. Now, this is what FBN Quest, another research analyst firm, sent in this morning about an hour ago. And they said the Nigerian market, and this was basically speaking to the Nigerian stock market, outperforming a number of other big markets in Africa, the Kenyan market and the GSE in South Africa, says the Nigerian market, this paragraph 3, has benefited from an improvement in macro data and news.
Correct. Both macro data and news. Speaking of number one, the improved FX markets flexibility. After the implementation of the high and heel window in April 2017, foreign investors who were at first spooked by the lack of foreign exchange liquidity, they were able to, come into the markets and get their FX, at the price that they want. So that has encouraged, capital inflows into Nigeria.
So technically speaking, from a macroeconomic point of view, something is going on right within the Nigerian economy.
Correct. In terms
and that
of
is attracting.
Prices, yeah, but the things going on right, they are cyclical in nature. We haven't really seen a structural economic shift.
Okay.
Cyclical in terms of oil production and oil prices. These are cyclical metrics. They come up and they go down, depending on the nature of demand and supply, in the global markets. But the real structural reforms needed to encourage long-term capital.
So the oil money is coming in, and oil production is very sweet. Foreign investors, portfolio investors like such scenario. Yes. They love the oil money. They love Nigeria's oil money. Correct. The way they loved it in 2011 to 2014, isn't it?
Yeah, correct.
So portfolios money were coming, and just as we're heading into the elections, they took the next available flight because they have their passports under their pillows, and off they go. Now they are coming back. Yeah, isn't it?
Yeah, they're coming back.
So when things were down and we're down on our knees in 2016, what did foreign portfolio investors or foreign investors says they want to see with Nigeria?
Because many of these foreign investors, they invest across a number of frontier markets. So if they can't bring their capital into Nigeria, they can allocate it to Kenya, they can take it to, Tanzania or any other frontier markets. So for us, what they were asking from the government is particularly more flexibility in terms of the FX management structure. They want to see transparency in the allocation of capital in the FX markets. And in April 2017, the Central Bank of Nigeria listened to their call, and we had the high and heel window, which has boosted sentiment in the economy and the capital markets. And with improved, improved oil prices and improved crude oil production, we have seen the volume of intervention in the foreign exchange market by the Central Bank of Nigeria. We have seen this increase, which has boosted liquidity, in the FX market. And in addition to that, we have implemented a tight monetary policy regime over the past 1 year, which has driven up yields in the fixed income market to a very attractive level. So for most foreign portfolio investors, they could see a carry trade opportunity. Borrow money at a low interest rate in advanced economies at 2-3%, and invest it in a frontier economy such as Nigeria, where you can get 20% return on your investments. So that's a 17% or 18% spread, such that even if there is a subtle devaluation in the currency, they are still going to make enough, enough gains to complement, to compensate them for the risks they are taking investing in our market.
Yeah. A quick one. We've done about, I need to get this, about 39.6% index return year to date in Nigeria. I mean, since 1st of January 2017, the Nigerian stock market has done 39.6% in terms of return. Is this real?
It is real because equity market returns are driven by two factors. They're driven by expansion in valuation multiples. When foreign investors start seeing your markets as being attractive, it's a positive macro story. They're going to be pricing your equity. They're going to be pricing your stocks at a high level of valuation. Second factor that drives equity markets return is earnings per share, earnings. And on both metrics, we have seen improvements. Earnings per share, it has improved across sectors in Nigeria and across the Nigerian market due to the rebound in macroeconomic fundamentals in the past 3 or 4 quarters.
Not because we're pumping the shares. Were we pumping the shares?
Not essentially. It's been driven by solid earnings growth across the banking sector, the consumer goods sector, and even the industrial goods sector.
So what drives earnings?
What drives earnings is the macro story.
Okay,
right?
What is macro story?
The macroeconomic
I'm sorry, I got a lot of questions for you this morning.
The
this is hot money.
The macroeconomic fundamentals.
Yeah, which means, if we break it down, meaning what? Consumer demand?
Consumer demand, number one, and for banking stocks, increase in yield in the fixed income markets as well, because that's where they put their assets in. So improvements in the yield, or rather the tight monetary policy by the central bank, which has driven up yields in the fixed income markets, it has increased the interest income of banks, so that they are now declaring record earnings numbers. And for the consumer and industrial goods sector, the growth in their earnings is not being driven by higher demand, but rather increase in the pricing of their products.
Yes, so you increase prices, but I've got to buy.
Exactly.
Which means the money is coming from somewhere. It's not free.
Yeah, essentially.
Yes.
Essentially.
So somehow there is something at the bottom of this economy where consumer appetite remains strong, even though prices go high. A loaf of bread moved up from 300 naira, from 250 to about 300, and folks are still producing more bread, and bread is still being consumed.
Correct. We are seeing improvements in consumer and business confidence, which is also triggering, these improvements in...
Very soft, but it's still there.
Yeah, correct. Definitely.
But again, let's go back to Broad Street and look at the Eurobond and the debt market and add that to this conversation. When a sovereign goes to the market, investors still buy junk bonds, so whatever you rated, folks still interested in Venezuela anyway, even though it's already becoming a basket case. But when you look at Nigeria, where is this? What's driving the appetite for the Eurobond from these folks we can call the hot money investors, which just did a Eurobond, the longest, 2047?
It's a push and pull factor. Push factor in the sense that in the advanced economies, because of the low interest rate environment there's a lot of demand for high yield emerging and frontier markets Eurobond. So even for companies with shaky fundamentals, they can easily tap the Eurobond market as long as they can price in the risk, in the valuation of the bond at issuance. So that demand for high yielding, Eurobonds, it has led to a push factor that has made, most Eurobond issuances this year very successful. And there's a pull factor as well, because most foreign investors understand that Nigeria's business cycle is driven by oil earnings, essentially. And since the start of the year, we are seeing a rebound in both oil production as well as oil prices. So that means the macro story for the economy, at least in the short term, it has improved quite substantially. So that push and pull factor, it has been driving, the interest we are seeing in our Eurobond. So if you look at the Eurobond, the Nigerian Eurobonds year-to-date return, both across the corporate markets and the sovereign markets, they've all appreciated year-to-date in terms of prices, being driven by this high demand that we are seeing, as well as the positive growth story that we are recording in the economy.
Is it likely that as the administration begin to tinker with the yield on Naira local currency, LCY instruments for treasuries and bonds, do you think the appetite of foreign investors will remain, these hot money investors will remain very strong, even though we see yields being tweaked a little bit lower and lower?
Definitely, because if you look at 2014, yields were not at this level, but we're recording higher level of capital inflows than even now. I think so for these investors, what they want to see is further consolidation, of the rebound in macroeconomic fundamentals for them to remain invested in Nigerian assets. Definitely, yields have to come down, because at the current level they are quite unsustainable and detrimental to the growth objective of the central bank as well as the federal government. So yields have to come down, and if you look at the fixed income markets in the past couple of months, you will see that at the primary markets, we've already seen a significant decline in the issuance yield. For the 364-day HOMO, which is to be done at over 18.6%, that has moderated to about 17.8% or thereabouts. Also, if you look at the FGN monthly bond auction, we have seen a decline in the yield. The last auction that was done, both for the 10-year and the 20, both of the 5-year and the 10-year reopenings, they were issued at 14.8%, 20 basis points lesser, than they were issued at the October bond auction, and over 100 basis points lower than they were issued at the January bond auction. So that shows that we are now seeing improved appetite, for the healthier instruments.
I got a very quick question for you, and this is going to be the last one. Of what use, quick use? Hot money is quick, come easy, go easy.
Correct.
Okay, so what can we use them for as soon as we get them? Do they really have any benefit or impact on the economy, broadly speaking?
They are useful in stabilizing your FX markets when they are coming in, and they are useful in supporting external reserves, of the economy. But you do not want to waste a recovery. So as long as we are witnessing this, higher capital inflows, both the federal government and the central bank have to deepen reforms so as to make it very competitive to do business in Nigeria, so that these inflows can be used to support, business growth in the economy and diversify our export base, particularly.
Thank you very much. It's just the advice there that we should hold this hot money down and pour cold water on it, if possible, and so that it stays.
Correct.
Omotola Abimbola from Afrinvest, one of the investment analysts, unpacking that for us.